Welcome to Tax Bites for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Avoid the hassle of dealing with your bank and transfer online, by app or over the phone or Currencies Direct today. Keep listening for an exclusive offer for Tax Bites for Expats listeners, and thanks to Currencies Direct for their support of this podcast. And just listening to you talk, what mistakes do you see people make with respect to residency? Just a high level kind of observation we have is sometimes people thinking they can pick their residency position.
Oh, everyone, people think they can be resident where they choose and that no one will ever know. No, how will they know? That's the comment you hear. They don't scan my passport, they don't do anything. That's like, because when you put down, when you're buying tickets for either a ferry or an aeroplane, you always give your passport number. And it's nothing to do with the airline. They pass that information on to the country where you're leaving and the country you're going to. So they actually know exactly where you are because you've already told them. And they do share that information. I know this because I had a client who wrote to the immigration department and asked when they'd arrived and left the UK. And they wrote back and they gave him all the information. And they even told him which flights of his were late from the scheduled time. It is... The Inland Revenue have this system called Connect. It's a really, really powerful system that's connected to Ministry of Justice, DVLA, the banks, the Department for Immigration. It's huge. You have no concept. The council tax. Most people have no concept. I have a phone of a certain brand that releases a new one every year, and that phone knows everything about me.
Yes, of course.
As does a certain shopping thing. And the revenue doesn't actually know that much less about me, to be honest with you. And they will ask for things like, if they really have doubts, they would ask for things like computer records. They'd ask for the dumps for where your phone calls, where you were buying, using your credit card, where you were using your bank cards, everything.
And that's a really, important point because we get asked that a lot as well. And, from an Irish perspective, revenue offices don't generally go into the minutiae of how they track or analyse this data. But we know that they spend a lot of money on their big data analysis. And it always baffles me that if I can open my phone and Google can tell me where I've been everywhere, why would we think that it's any different? And this is not necessarily, a big brother is watching. From an Irish perspective, and I'm keen to hear your thoughts on the UK side, we often say to clients, when we're asked that question, well, it's a self-assessment system. It is an honesty system designed that It's
an honesty box.
It's an honesty box. So the bit that happens where they come back and realise that you're not telling the truth is the bit when you have perhaps disclosed something incorrect. That is the motivation to tell the truth, even if it's not. So it's the same in the UK. In other words, you would say to clients, it's an honesty box, it's a self-assessment system. And if there's an intervention, now we know that they can, if you have made a mistake, they can actually cross-reference very easily.
Oh, very, very easy. And people just don't realise. In Spain, the tax authorities, they wrote to... So in Spain, if you're a Spanish national, you have, I think it's called NIF number. If you're a foreigner and you need a tax number, it's called an NIE number. So it's the same thing. It's a tax identifier. And many years ago, Germany wrote to Spain and asked for details of all the German nationals who had bought property in Spain because they needed an NIE number to do so. And they gave them the list. And there were an awful lot of people. And at the time, Germany had a wealth tax. And so they used that information to cross-reference declarations. And also in Spain, you need to put the NIE number or your NIF number, whatever, onto your bills. So if you're allegedly not renting your apartment or your villa and the bills are huge, then they'll actually start looking at whether you're renting it or not.
Okay.
So, there's all these things here that people just don't think about.
And I don't think they do. And I think as well that the majority of people, they're very eager to comply. But I suppose that question does come up, what do they know? Speaking of what people know, what do people need to know if they've left the UK, but they still have UK assets? And I know that's a very broad question, so feel free to give me a broad answer.
If you've got UK source income, so double tax treaties are there to stop income and gains being taxed twice. That's what they're designed to do. They're not designed to help you pay no tax, although it can be possible due to the way some of the rules work. And it doesn't stop you paying the highest of the two liabilities where tax is due in both countries. So what it actually generally does is it's got tiebreaker for residents. So you can only be tax resident in one country at a time, entities and individuals. So it usually has tiebreakers for residents. It says what taxes are covered. And then it goes through a whole list of different things like business profits, dividends, royalties, interest, income from employment, all sorts of things, pensions, teachers and students' income. And then we'll say which country gets first dibs. And there'll usually be a clear-up article at the end saying, if it's not covered above, it's taxable solely in the country of residence. So that essentially is the anatomy of a double tax treaty. And then it says how it gives relief where income is taxed in both countries. Because sometimes, income can be taxed solely in the country of residence, less usual solely in the country where it originates. And things like rental income and capital gains, especially on property, is usually in both countries, the source country and the country of residence. And you can't just look at one article of the double tax treaty, you have to read the whole thing or the elimination, double taxation, then see if there's a limitation clause and so. So it's really not as clear cut as it first seems. So usually if you have UK source income, it will often remain taxable in the UK. And that's what people get wrong, and gains, particularly on real estate.
Mm-hmm.
I don't know a single UK treaty, and I admittedly I haven't read the some 200 we've got.
You've got over 200. Wow. Okay.
Yeah, we've got one of the largest tax treaty networks in the world.
Because we've got a large one, but that's bigger.
It's because we've been tying our people back into the UK for longer, I expect. So we have this huge network, and every treaty is marginally different. Very few are identical. So yeah, it's a case of looking into each one very carefully to see how it works. So don't believe that your income, and don't believe that just because you're reporting in the UK, it isn't taxable where you're going either. That's the other biggie.
Exactly. And the misconception that we come across frequently is, well, I've already paid tax in such and such a location, so the double tax treaty means I don't have to do this. And it's very much an education piece around, well, that's not really how it works. You explained it beautifully there. And I think, just kind of coming back to what you said there about the ability for cross-jurisdictional reporting to highlight when you get it wrong, as well as the complexity of getting it right, absent any good advice, can mean, and does practically mean, that an expat client has a higher risk of making a mistake than a domestic person who just has.
Yeah, and a lot of the time that mistake's not necessarily going to be picked up on either. I've got a couple just moving back to the UK. He's got French pensions. They've been out there for 25 years. They are UK nationals, and she's got a very small teaching job, self-employment. And her French accountant's saying, well, do it up to the end of the year. It's like, yeah, but you moved halfway through November and the double tax treaty actually, and France does split the tax year, as does the UK. And you've sold your house, you've left France. It's quite clear you're not resident there anymore. And it's like, oh, well, yeah, but the people who I work for don't want to do this. And it's like, and I won't be, yeah, but unfortunately that's the way it works. Yeah, I can't change that. But, we may be talking a couple of €100. So would anyone ever really look into it? I don't know. But obviously I can't advise not to. I can only advise the correct way of doing it.
Yeah.
But then you have other people with massive differences in their, oh, but I've paid tax there. It's like, I've been declaring it. Like, but unfortunately, that's not going to work in your new country. It's and also if you move and you've got a business and even a limited company, you may change the country of residence of the business, and that's a biggie too. And even if you don't change the country of residence of the business, you could still have a permanent establishment in that new country, which will want to tax those profits.
It's very common.
And it's huge. Yeah. In the UK, you cannot re-domicile a company. Can't even re-domicile a Scottish company to England and Wales, or vice versa. It's just not possible. You can change the residence for tax purposes. And then that's also covered. There's also double tax treaty, tiebreaker for corporate residents and stuff like that. But, even if it stays resident in that one country, this permanent establishment that you're running the business from, so I'm got my own business. I can go and live anywhere and do this. I'm actually in Malta at Christmas, and I'll be working in Malta because, there's no rest for the wicked. And it's coming up to the end of the UK tax return season. So, but if I wanted to go and live there, and I could, there's various visa issue things that I can do, it wouldn't be a massive benefit because it would still be a company that's moved to Malta, because I would be running it and controlling it, and under both UK law and Maltese law, there would at least be a permanent establishment there. And therefore, I couldn't benefit from all those wonderful, and Malta's got some lovely residence regimes with really nice tax breaks, but I couldn't benefit from them because it would be a Maltese company, because it would be Maltese resident.
And now a quick word on our episode sponsor, Currencies Direct. If you're looking for a fast, easy way to transfer money to or from Ireland without the hassle and cost of dealing with your bank, keep it simple with Currencies Direct. Whether you're buying property or require regular currency transfers, Currencies Direct can help you save money. As a special offer for our listeners, when you use the link in the show notes and quote expat taxes when registering with Currencies Direct, you'll receive a €50 one-for-all or Amazon voucher when you transfer €5,000 or more in your first 6 months with Currencies Direct. Registration is quick and easy, and you decide how you transfer 24/7 via their online money transfer service, over the phone with one of their friendly experts, or by using their handy mobile app. Check the show notes or head to currenciesdirect.com to register, and thanks to Currencies Direct for the support of this podcast. We see this so commonly, and, there's generally a misconception that, well, firstly, my end client is not in my country, so therefore that's one determination in I have a foreign source of income. No, generally income is sourced where the work is performed regardless of individual or company.
Exactly. Yeah.
And then secondly, what we often see, and this is a difficulty for people because there's so much to think about when you're relocating internationally. But generally corporate structures, even if it's just a personal service company, so by that I mean an entity that you have a shareholding in and you also are performing services for an end client by way of an employment or directorship, they often can give rise to certain tax outcomes when set up in a certain way. So for example, in Ireland, it is quite efficient to have a company contribute on your behalf to a pension scheme. It can be an efficient thing to do. The company puts money into the pension scheme and you get some nice tax outcomes. When you relocate, you may not get that exact outcome anymore, or it might look differently in the jurisdiction that you're going through.
Yes.
So I think this is an important point because often we focus on the individual and their personal situation, but you need to really think about how you have set up your business structures. Even if it's just one-man band. It doesn't have to be, we're not talking multinationals here.
Absolutely. But that's when it's more likely to have changed residence as well.
Exactly, because it's just you.
Because you are the management and control, or there's different phrases they use. Management and control is one that the UK uses. So and it's huge. It's people don't realise the impact they have, and companies let their employees go and work anywhere, and don't realise that they're creating permanent establishments, and that and also have they got the right visas, and you do realise that their social security's moved, so therefore your social security liability has moved.
potentially in the wrong jurisdiction. Mm-hmm.
And of course, they could have moved to a country where it's much lower social security for them, but much higher for the
Mm-hmm.
employer. And the employers just said, yeah, go for it. And at the end of the day, it's not beneficial.
We see that a lot between Ireland and the UK. You know, a lot of movement during COVID. Somebody based in the city in London decides to come home to Ireland and will commute back and forth. Very frequent. Interestingly, I believe the OECD are doing work to kind of update the commentary on the implications of long-term remote work. And have had some guidance around, you know, whether it's more or less than 50% of the time, et cetera, et cetera. So not to kind of, you know, get bogged down in that detail, but doesn't that just show how long it can take tax legislation to catch up with reality? That updated commentary was actually relevant in the middle of COVID, but we are now 5 years on from the pandemic. And this is the point that I think sometimes as well clients have to understand, is that legislation, whether it be UK, Irish or international, you know, a lot of these treaties and legislation can be quite old and archaic in terms of the circumstances that it was designed to cater for.
Well, it's not designed to cater to influencers who travel around the world. It's not designed for things like these, you're seeing digital nomad visas all over and things like that. And a lot of those, you still have to work for a company that's located outside that jurisdiction. But if you're that company and you're moving around, you know, it's really quite complex and difficult. I mean, I don't do corporate. I do advise on permanent establishments, things like that for companies. But, you know, that's not really my area of speciality. And corporate residence is fraught. And just staff residence and having people all over the world, you know. And you know, in the UK, we have what we call IR35 legislation, which means you can't just work for one business. Because if you work for one business, you know, really, are you an employee? Is it just a way of avoiding national insurance for both the business and the individual? You know, so we have this legislation, but that doesn't exist elsewhere in the world necessarily. Although some countries do have rules that start to look at you if you're only working for one employer. Are you really employed?
Yeah, it's helpful to add substance and demonstrate that there's, you know, more than just one. We don't have comparable IR35 in Ireland. We do have a recently updated code of compliance where we had some case law that kind of, it's an area of focus, let's say, and it's an area that clients would do well to be cognizant of. Nikki, firstly, there's so much to this, and I kind of feel we've just glossed over the surface.
We can do another one.
We need to. We need to do many because there's just too many topics for us to cover. You know, with any kind of depth to them.
I'm always happy to talk tax. Love talking tax. I find it fascinating.
Oh, so do I. Enjoy it. Because most of the episodes we record tend to be perhaps on different aspects of the move. And I personally really enjoy these kind of heavy technical ones. What I'd like us to finish on is if you can quite briefly talk us through what a consultation with you is like. You know, when you approach them, do you have a format you use, or what is your modus operandi when you meet with client in consultation?
It's all about them. And I tell them that, you know, it's all about you now. So you tell me what you want, what you're trying to achieve, what you're trying to do. And then we see how we can make that work.
Mm-hmm.
Because at the end of the day, that's what it's all about. It's always got to be client-centric and client-focused. So I let them talk, and then I just try and get as much information as I can about their income. So it depends what they're doing as well. You know, I've got a client who lives in New Zealand who received dividends from a UK company and, you know, reporting in the UK. And so something like that is fairly easy. We talk about that. And then it's just a tax return that she needs to do, get that done, dusted, and that's over. And obviously, if she needs to do one in future, if someone's moving, then we'll look at all of their income, what their assets are, what they're looking to do, make sure they understand the rules, how long they're going to be caught by the UK regime, or what they're coming into if they're coming here permanently or longer term, and then just work out where it's best. You know, so yeah, they say, oh, we've got ISAs, and saying, and that's great. Are you going to come back? It's like, no, it's going to be permanent. Well, we think so, but but ISA income is taxable abroad, and if you're going somewhere, living there permanently, there might be something that's more tax efficient for you in that country. because, ISAs are basically interest and dividends and gains, all of which could be taxable. It's only a tax sheltered in wrapper in the UK.
Correct. Same in Ireland. It's not. We like clients to review their ISAs before they become Irish resident for that very reason that you've just mentioned.
And the first thing to do is, like, if you've got ISAs, sell everything in it and buy it again.
Yeah, rebase,
because realize all those gains, and then because when you go to a new country, although Australia is actually different. Australia, you literally tell them what everything's worth when you arrive in Australia, and they only tax the gains thereafter.
That's rare.
Yes, that's extremely rare. If you came to the UK with a huge amount of Schreiber stock or something from Germany, and you haven't rebased it or whatever first, then the UK will tax the whole gain.
Mm-hmm. I think the Irish-Canadian treaty has some limited step-up and cost basis, but save that. Our treaties are exactly the same, and I say to clients, we tend to focus, we myopically focus on residency sometimes, and it can allow clients to believe that is the point from which everything is taxed. But no, once a gain is swept into the Irish tax net, it is with reference to the original acquisition cost.
If you have a period of non-residence anywhere, then whatever income and gains you have will usually be taxed in the source country during that period, unless it's from the UK, in which case we've got some lovely rules that are easy, literally to take advantage of, because we don't tax non-residents on certain things.
And it just strikes me, anyone listening to this who is planning to move back to Ireland from the UK, move to the UK from Ireland, or to from the UK, insert country here, they really should, I suppose, do well to book to speak with you, because there's so much to this. And that's from my perspective, even as an Irish advisor listening to you talk, it strikes me the plethora of experience you have and the fantastic way you have of explaining what you do. So thank you so much for coming on, and let's do another one soon.
Definitely. My pleasure. Thank you very much for having me. Cheers. Bye.
Thanks for listening to Tax Bites for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.